Hey there, investors. Ever wonder why some people seem to strike gold in the real estate market while others lose their shirts in stocks? Stick around because today we're unraveling the paradox of investing, why it's simple yet not easy, and the five crucial principles you need to follow to succeed. Let's dive right in. Welcome back to Insight Simplified. If you find investing intimidating or confusing, you're not alone. Warren Buffett, the Oracle of Omaha, famously said, "Investing is simple, but not easy." At first glance, simple and easy might seem like synonyms, but in the world of investing, there's a massive gap between the two. Today, we're going to break down this concept and arm you with principles to navigate the complex world of investing with confidence. 1. The real estate versus stock market paradox. Let's kick things off with a question. Why do more people seem to get rich buying houses than buying stocks? Over the past couple of decades, both the stock and real estate markets have generally risen. But the average person buying a house seems to fare better than the average person picking stocks. Why is that? In real estate, the success factors are pretty straightforward. Location, location, location. Most people can identify a prime location versus a less desirable one with some basic knowledge. Even if you make a less than ideal choice, the worst case scenario is usually just slower appreciation, not massive losses. Contrast with stocks. Stock picking, however, is like finding a needle in a haystack. Most companies don't outperform the market, and identifying those that will is extremely challenging. Even in a rising market, it's easy to pick a loser and suffer significant losses. Detailed analysis. Think about it. In the housing market, a bad investment might mean your property only appreciates by 2% annually instead of 5%. But in the stock market, a bad pick can result in a total loss if the company goes bankrupt. The real estate market benefits from being a tangible asset. Even if the price fluctuates, you still have a physical property that holds inherent value. Stocks, on the other hand, are far more volatile and susceptible to market whims and corporate mismanagement. 2. The counterintuitive nature of investing. This brings us to a key counterintuitive aspect of investing. Just because something is harder doesn't mean the rewards are greater. In fact, the market doesn't reward you based on the difficulty of your efforts. It rewards you based on results, regardless of how simple or complex your strategy is. Psychological insight. Humans have a natural tendency to equate effort with reward. If something is more challenging, we expect a higher payoff. But in investing, this mentality can lead to poor decisions. It's the results that count, and sometimes the simplest strategies yield the best outcomes. This is a humbling realization for many, but it's crucial for long-term success. For instance, consider the rise of index funds. John Bogle, the founder of Vanguard, revolutionized investing by promoting low-cost index funds. These funds don't try to beat the market, they simply mirror it. Over time, they've consistently outperformed many actively managed funds. The simplicity of this approach, low fees, broad diversification, and minimal trading, has made it incredibly effective. 3. The importance of avoiding temptation. So, how do we ordinary investors navigate this landscape? The answer is to avoid temptation and stick to solid principles. Many people who made money in real estate did so almost passively. Real estate transactions are slow and prices aren't transparent. This lack of liquidity and price transparency can actually be a blessing, as it prevents panic selling and rash decisions. Hypothetical scenario. Imagine if every house had a ticker symbol like a stock, with prices updating in real time. Do you think as many people would have held onto their homes long enough to benefit from long-term appreciation? Probably not. Real-life case study. Consider the 2008 financial crisis. Housing prices plummeted, and many homeowners were underwater on their mortgages. However, those who didn't panic and sell at the bottom of the market often saw their property values recover and even surpass previous highs in the subsequent years. This resilience wasn't necessarily due to strategic insight, but rather the illiquidity of the real estate market, which made it harder to make impulsive decisions. Research insight. A study found that frequent checking of stock accounts correlates with lower returns. Investors who log into their accounts less frequently tend to perform better, avoiding the noise and temptation to make impulsive decisions. 4. The 5 core principles of successful investing. Let's sum up the core principles every investor should follow to succeed, especially when things get tough. Diversification. Spread your investments across different asset classes and markets to reduce risk. By diversifying, you ensure that the poor performance of one investment doesn't drastically affect your overall portfolio. This can include a mix of stocks, bonds, real estate, and even alternative investments like commodities or cryptocurrencies. During the dot-com bubble burst in the early 2000s, many tech stocks plummeted, causing significant losses for those heavily invested in that sector. However, investors with diversified portfolios, including bonds and real estate, were better able to weather the storm. Passive over active. Consider index funds or ETFs that mirror market performance instead of trying to beat the market with active trading. Passive investing reduces costs and often results in better long-term performance due to lower fees and less frequent trading. Research consistently shows that the majority of actively managed funds fail to outperform their benchmark indices over the long term. By investing in index funds, you're aligning your performance with the market, which historically trends upward over time. Cost efficiency. Minimize fees and expenses to maximize your returns over time. Even small cost savings can add up significantly. Look for low-cost funds and be mindful of trading fees. Let's say you have a portfolio worth $100,000. If you're paying 1.5% in fees annually, that's $1,500 each year going to fees. Over 20 years, assuming a 6% annual return, those fees could cost you over $60,000 in lost value. Opting for a fund with a 0.5% fee would save you significant money in the long run. Long-term focus. Avoid trying to time the market. Think long-term and stay committed to your investment strategy. The market will have ups and downs, but historical data shows that staying invested pays off. During the financial crisis of 2008 to 2009, the S&P 500 dropped over 50%. Many panicked and sold their investments at a loss. However, those who stayed invested saw the market recover and reach new highs within a few years. Patience and long-term thinking are crucial. Know your limits. Don't invest in things you don't understand. Stick to what you know and avoid unnecessary complexity. Investing in familiar industries and products can help you make more informed decisions and reduce the risk of unexpected losses. Warren Buffett famously avoids investing in technology companies because he doesn't understand them well. Instead, he focuses on businesses with straightforward models that he can analyze and predict with greater certainty. Conclusion. These principles are straightforward, but following them consistently can be challenging due to the constant lure of hot tips and surefire investments. Accept your limitations and play to your strengths for the best chances of success. 5 real-life application and final thoughts. Let's put these principles into real-life context. Imagine you're starting with a $10,000 investment portfolio. How would you apply these principles? Step-by-step guide. 1. Diversification. Allocate your funds across different asset classes. For instance, 40% in a broad market index fund, 30% in bonds, 20% in real estate investment trusts, REITs, and 10% in a commodities ETF. This spread ensures that you're not overly exposed to the volatility of a single market. 2. Passive overactive. Choose low-cost index funds for your stock and bond allocations. Vanguard and Fidelity offer excellent options with minimal fees. Avoid trying to pick individual stocks or time the market based on trends or news. 3. Cost efficiency. Look for funds with expense ratios below 0.5%. Many index funds offer expense ratios as low as 0.03%. Use a brokerage account with low or no trading fees to minimize transaction costs. 4. Long-term focus. Set a clear investment goal, such as retirement savings or a down payment on a house, and commit to it. Resist the urge to check your portfolio daily. Instead, review it quarterly or annually to make necessary adjustments. 5. Know your limits. Stick to investments that align with your knowledge and experience. If you're not familiar with cryptocurrencies, avoid them until you've done thorough research. Consider consulting with a financial advisor if you need guidance, but be wary of high fees and ensure they have your best interests at heart. Final thoughts. Remember, investing is a marathon, not a sprint. The principles we've discussed today, diversification, passive investing, cost efficiency, long-term focus, and knowing your limits, are designed to help you build a solid foundation for your financial future. It's about making informed, strategic decisions. If you found these tips helpful, make sure to hit that like button and subscribe to Insight Simplified for more investing insights. Remember, investing may be simple, but it's not easy. Stay informed, stay disciplined, and you'll be on your way to financial success.